Hello class, welcome to some explanation about some long-term asset and liability issues that we need to deal with. Just a reminder that on the syllabus, as you see in front of you, there are some additional reading, references to the codification, a link and things to help you go over the information for this section. So don't forget to check there on the syllabus, as well as the other materials that are provided in the learning module. There is references to places to read in the codification as well as other resources. So we're going to use some PowerPoint slides. I can pull them up appropriately to review some of this material. So first of all, we're going to look at the issue of the cost of long-term assets. So first of all, how do you record the long-term assets on your balance sheet? What cost do you use, and what cost then will you use for depreciation and so forth going forward? So first principle that we want to make sure we know that goes beyond what we learned in Accounting 101 is that we have to adjust for the time value of money. So if an asset is acquired with a deferred payment, meaning in the future payment, then we cannot record that asset for just the amount of that payment, because the amount of that payment is not equal to the asset, because as we learned in last week, that the present value of those payments is not the same as what they are today. So we need to look at that without the interest involved. So first application of present value is acquisition of assets, and you had a little example of that in our homework last week, in that an asset was acquired with two payments that had no interest, and we had to record that asset at its present value of those future cash flows because no interest was involved. And that's the issue here. If an appropriate interest rate is involved, then you don't have to apply the present value concept. Another idea that sometimes trips us up is the difference between acquiring our long-term assets from others or developing them internally. So if we come up with an idea and do some research and development on that idea and create a copyright or a patented concept internally, all of the costs to develop that will be expensed as research and development, will not be an asset. But if we instead bought that patent from some other company, we would record the fair value of that, or what we paid for it, which should be the fair value, on our balance sheet. So a much larger, in theory, amount would be recorded depending on whether, if we acquire it from others. So that's something to remember, especially when it comes to intangible assets like copyrights, patents, that sort of thing. Now, another new idea is asset retirement obligations. This was not covered in Accounting 101. This is the idea that we, instead of having a salvage value at the end of our useful life, that means that we can sell the asset for a certain amount at the end of the useful life. This is a situation where instead of selling it and receiving cash, we're going to pay cash, either to put it back the way it was or to get rid of it, make sure that it's disposed of properly. And in today's sensitivity to the environment, this is becoming more and more an issue, because many assets cannot be just thrown in the garbage. They actually have to be disposed of appropriately, because they contain dangerous chemicals and other things like that. But often you will see a situation where a mine or a landfill has a useful life, and then at the end it must be put back the way it was or made into a park or some other way to put it in. And that cost in the future that you're going to have to put that back the way you found it, or you make it even better, is called an asset retirement obligation, meaning it's your obligation to get rid of that asset. So how do you calculate that amount? You use that present value we practiced in Excel last week of an estimate of the future cost. So you estimate how much it's going to cost to make that into a park or dispose of that asset, and then you take the present value of that in today's dollars using an appropriate interest rate, the normal interest rate you use for other loans or things that you might have outstanding, and you add that to the cost of the asset and you create a liability. So if the mine costs you $1 million, but you have a $500,000 asset retirement obligation, you take the present value of that $500,000, then you add it to your asset. So now the asset would be, the mine would be the cost plus the present value of that asset retirement obligation. You would credit the amount of that asset retirement obligation to a liability and probably call it asset retirement obligation or liability for putting it back the way you found it or something to that effect, and that present value would be recorded as a liability as well. So what's going to happen, and the thing we sometimes forget, is that liability is going to increase over time each year as the time that you have to put that asset back to the way it's supposed to be gets closer. The liability grows. That's the idea of present value. It just gets bigger and bigger as we get closer and closer to the time that we have to make that payment. So as that does so, we need to credit that liability and debit, and the official term in the codification is accretion expense. But that sounds pretty disgusting to me, so you're welcome to use an interest idea there, because that's essentially what it is. But you need to record that every year. The obligation's getting bigger, and there's an expense associated with that each year. That's just a return to our asset retirement obligation. That's on top of any depreciation. That accretion expense or interest is on top of any depreciation, and the depreciation would be calculated using the total of the amount that we paid for the asset plus that present value of the asset retirement obligation. Okay, so don't forget to have both those numbers in when we calculate depreciation. Capitalized interest is another issue with regard to acquiring long-term assets. And this is calculating how much it costs us to add that asset. So this applies in a fairly narrow scenario, and that is when we have constructed the asset ourselves. We built it instead of buying it already built. And the idea is that part of the cost of building it is that we would have to borrow money to build it until it's useful. And so for the time that we start to build it to the time it actually gets used, we're going to try to measure the interest that it cost us to build that. Just like we would have to pay a builder if they build it for us, we would have to pay them enough to cover the interest. That's what we're trying to calculate here. So our concept is it's only the amount of interest that could have been avoided. So you have to calculate how much could have been avoided if we had not built the asset. So we first calculate how much we spent on construction. We do a weighted average expenditures on how much we spent. So if we figure out we spent $200,000 at the beginning of the year, that would have been an expenditure for the entire year. And then as we go through the time frame of the construction, we just continue to increase the amount of expenditures and shorten the amount of time. And you'll see that in an example that I've given you in a document. Also, we're going to use the interest rate on loans specifically for construction first. Always use the specific interest rate for construction loans first. If your weighted average expenditures are higher than the amount that you borrowed specifically for construction, which is common, then you're going to use the weighted average interest rate on other debt outstanding. The theory being that if you had not built this asset, you could have used the money you spent on that to pay off other debts. So we're going to use that other debt on weighted average, but only if our expenditures, our weighted average expenditures, are more than the borrowing for specific construction. So that's the key. So there's kind of a two-step thing. You look, once you got your weighted average expenditures, then you compare it to your borrowing for specifically for the construction and then any other borrowing.